Welcome back to the Deep Dive. Today, we're diving into the world of Ferrari.
Ooh, exciting.
It is.
Yeah.
Especially, I think, for, our listeners out there.
Yeah.
You're thinking about maybe adding some luxury brands to your portfolio.
Right.
We're going to see if Ferrari is a good fit.
Yeah.
So we're going to be looking at a few different things, some articles, some analyst reports, all that good stuff to get a clearer picture.
Sounds good.
So
yeah.
Ferrari, they're known for luxury speed.
Of course.
And their new supercar, the F80, really embodies that.
Yeah.
It's a limited edition car, only 799 being made.
Wow.
And they're selling for a cool $3.9 million each.
That's a pretty penny.
It is.
Yeah.
But is that price tag justified?
Right.
And how does this all tie back to, your potential investment?
Well, it's interesting because while some car companies are struggling, particularly in the Chinese market, Ferrari seems to be doing pretty well.
Yeah.
They're generating a lot of buzz, and this new F80 is a big part of that.
Yeah. And I mean, the specs on this thing are pretty mind-blowing.
Oh, yeah?
You can go almost 220 miles per hour.
Wow.
Engine tech straight from Formula One.
Nice.
And they sold out that initial run almost immediately.
It's impressive.
Yeah. So I can see why people are excited about this.
Absolutely.
But I'm curious, can a car with such a limited production run really make a dent in a company's profits?
Oh, it definitely can. And that's where Ferrari's strategy really comes in. They intentionally keep production low to create that sense of exclusivity and high demand.
Okay.
And this allows them to command those premium prices and achieve some impressive profit margins.
Okay, so each F80 sold is a big win for Ferrari.
Definitely.
How big of a win are we talking?
Right.
One analyst report suggested that the F80 alone could contribute 20% to Ferrari's overall profits, even though it only represents about 2% of their total sales.
Wow.
Does that seem realistic?
It's absolutely plausible. Imagine if you sell 100 cars and each car gives you $100 in profit. You make a total of $10,000. But if you sell just 2 cars and each one brings in, let's say, a whopping $5,000 profit,
Okay.
you still make that same $10,000.
So it's all about the margin.
It's the power of high margins per unit.
Okay.
And in Ferrari's case, those margins are exceptionally high.
Especially for a model like the F80.
Especially for a model like the F80, exactly.
Okay, so even though they're selling fewer cars, the profit on each one is significantly higher.
Yes.
Leading to, a substantial overall impact.
Exactly, and that's a key thing for investors to consider, the success of this F80.
Right.
It directly impacts Ferrari's bottom line and ultimately your potential return on investment.
Speaking of the bottom line, analysts are predicting a 10% growth in Ferrari's earnings per share by 2025.
That's right.
Could you break down what that means for someone who might not be familiar with that term?
Sure. Earnings per share, EPS, is essentially the portion of a company's profit that is allocated to each outstanding share of stock. So 10% growth in EPS basically means that for every share of Ferrari stock you own,
right,
you could potentially see a 10% increase in the profit attributed to that share.
Okay.
It's a key indicator of a company's profitability and growth potential.
So that 10% projected growth, even before the F80 starts shipping in late 2025,
right,
is a really positive sign for potential investors.
It suggests strong confidence in Ferrari's future performance. And, it's also worth noting that this projected growth is happening despite some challenges.
Oh, really?
In the wider automotive market.
Like what?
We've seen companies like Ford cutting jobs, General Motors facing declining sales, especially in China. Does this raise any concerns for Ferrari?
That's a good question. Is Ferrari exposed to the same risks, or are they somehow insulated from these market fluctuations?
That's where Ferrari's unique market position really comes into play.
Okay.
Interestingly, their limited presence in China, which currently accounts for only about 8% of their sales, might actually work in their favor.
So they're not as reliant on the Chinese market.
Not as reliant, exactly.
As some of their competitors.
Exactly. And this means they're less vulnerable to the current downturn.
Okay.
And perhaps more importantly, they have more room to grow in that market in the future.
That's a really interesting perspective. So even though the overall car market might be facing headwinds, Ferrari's specific strategy could help them navigate these turbulent waters.
Exactly right. But there's another big question looming on the horizon.
Oh.
The shift towards electric vehicles.
Yeah.
How is a brand known for its powerful gas-guzzling engines going to adapt to this new landscape?
That was going to be my next question. You hit the nail on the head.
Yeah, could this be a major roadblock for Ferrari?
I know they have hybrid models, but is that enough?
Right.
To keep them competitive in a world that's, increasingly going electric?
Yeah, it's a valid concern, but the reality might surprise you. Over half of Ferrari's shipments in the third quarter of 2024 were actually hybrid vehicles.
Wow.
So they're clearly not ignoring the trend. And in fact, they're already making significant strides in that direction.
So are they working on a fully electric supercar to compete with, the Teslas and the Porsches of the world?
They are indeed. They're set to release a fully electric supercar in late 2025.
Wow.
And the estimated starting price is over $500,000.
$500,000 for an electric Ferrari.
So it seems like Ferrari is not just dipping their toes into the electric waters. They're diving right in, and they're doing it in a way that stays true to their brand.
Luxury.
Luxury.
Exclusivity and performance.
Absolutely.
So we've got this limited edition supercar, the F80, boosting profits.
Yes.
We've got a strategic advantage in a challenging market.
Right.
And a commitment to electric vehicles.
It seems like they're doing all the right things.
All things considered, is Ferrari stock looking like a good buy?
Well, Ferrari is currently trading at a price-to-earnings ratio of 52 times, which might seem high at first glance.
Wait, hold on a second. For those of us who don't speak fluent Wall Street, could you explain what a price-to-earnings ratio is and why it matters?
Absolutely. The price-to-earnings ratio, or PE ratio, is basically a way to measure how much investors are willing to pay for each dollar of a company's earnings.
Okay.
It tells us how expensive a stock is relative to its earnings.
Okay.
So a high PE ratio like Ferrari's 52 can indicate that investors are very optimistic about the company's future growth, and they're willing to pay a premium for that stock.
So in Ferrari's case, the high PE ratio isn't necessarily a bad thing.
Not at all. It's actually quite common for luxury brands and companies with strong growth potential to have higher PE ratios.
Okay.
It's a sign of confidence in the brand and its ability to generate future earnings.
So high PE ratio for a company like Ferrari isn't a cause for concern, but rather a reflection of its unique position in the market.
Exactly. And this is further supported by the fact that Ferrari rarely trades at a discount compared to other car companies. They have a proven track record of success and a brand that commands a premium price both for their cars and for their stock.
So does that mean it's a good time to buy?
Well, there has been a recent dip in their stock performance, which might make it more appealing to some investors.
Okay, interesting.
But before we jump to a conclusion, I think we need to dig a little deeper into their financials and see if they truly live up to that luxury goods superstar status.
Okay.
Let's take a closer look at their revenue profit margins and other key financial indicators to get a clearer picture of their overall financial health and their growth potential.
That sounds like a plan. Let's do it. All right, so let's dive into those Ferrari financials.
All right.
I've always been fascinated by how a company like Ferrari that produces a relatively small number of cars can be so incredibly profitable.
It's a fascinating case study, isn't it? And it really comes down to understanding that Ferrari isn't just selling cars. They're selling an experience, a lifestyle,
Right.
a piece of automotive history.
It's the brand, the legacy,
Exactly.
the feeling of exclusivity.
Precisely.
Okay.
And that exclusivity is reflected in their incredibly high brand value and the intense loyalty of their customer base. People are willing to pay a premium not just for the cars themselves, but for the privilege of being part of that Ferrari world.
Like joining an exclusive club.
Exactly.
But how does that translate into, cold hard cash?
Right.
How do they turn brand value into actual profit?
Well, think about it this way. Most car companies rely on volume to drive profits.
Okay.
They need to sell thousands, even millions of cars to make a significant impact.
Right.
Ferrari, on the other hand, can achieve impressive profitability with a much smaller number of sales.
Because each individual sale is so much more valuable.
Exactly. And this is a key factor for investors to consider, when evaluating Ferrari's financial performance, you can't just look at the number of cars they sell.
Right.
You need to consider the profit margin on each sale.
Okay.
Which is where Ferrari really shines.
So it's not about how many cars are rolling off the assembly line. It's about how much money they're making on each one.
Exactly.
And those profit margins are significantly higher for Ferrari than for your typical car company.
They are much higher. And this brings us back to the F80.
Okay.
With its nearly $4 million price tag and limited production run, it's a prime example of Ferrari's strategy in action.
So this one car, even though it represents a relatively small percentage of their overall sales volume, can have a huge impact on their bottom line because of those high margins.
Absolutely. And that ties back to those impressive earnings projections we mentioned earlier.
Right.
Analysts are expecting Ferrari's earnings per share to grow by 10% in 2025, largely driven by the anticipated success of the F80.
Okay, I'm starting to see how all the pieces fit together.
Good.
But I'm still a bit curious about the risks. You mentioned that Ferrari's limited presence in China is actually a good thing right now.
Right.
Because it insulates them from the current economic slowdown.
Yeah.
But what about in the long run? Aren't they potentially missing out on a huge market by not having a stronger foothold there?
It's a balancing act for sure. Right now, being less reliant on the Chinese market is working in their favor.
Yeah.
But you're right. China is a massive and growing market for luxury goods.
Huge.
And in the long run, Ferrari will need to carefully consider its strategy for expansion in that region.
So it's a potential growth opportunity, but also a potential risk.
Exactly.
If they don't handle it strategically.
If they don't handle it strategically, that's right. And then, of course, there's the ongoing transition to electric vehicles.
Yeah.
While Ferrari is clearly making moves in that direction with their hybrid models and their upcoming electric supercar, the majority of their current lineup still relies on traditional combustion engines.
So how do they balance their legacy of, high-performance gasoline engines with the increasing demand for electric vehicles?
Right.
It seems like they're straddling two worlds.
They are, and the success of that electric supercar is going to be a major factor in determining Ferrari's future performance. They need to prove that they can maintain their brand identity and performance standards in this new electric era.
I imagine there are some diehard Ferrari fans who might be resistant to the idea of an electric Ferrari.
No, absolutely. It's a big shift.
It is a big shift.
Yeah, but if any company can pull it off, it's probably Ferrari.
Yeah.
They have a history of innovation and pushing the boundaries of automotive technology.
Okay, so it sounds like we've got a mix of potential rewards and a potential risks here.
Yeah.
The F80 is generating a lot of excitement and revenue.
Mm.
They're strategically positioned to navigate, some of those market challenges.
Right.
And they're taking the electric vehicle transition seriously.
They are.
But there's always the possibility that things could go differently than planned.
That's the nature of any investment.
Right.
There's always a degree of risk and uncertainty, but with Ferrari, it's clear they have a unique approach, a strong brand, and a history of impressive financial performance.
So it's not a guaranteed slam dunk, but it's a company worth considering for the right investor.
Exactly. It comes down to your individual investment goals, your risk tolerance, and your overall assessment of the future of the luxury automotive market.
Okay, so we've talked about the F80. We've discussed Ferrari's unique business model, and we've touched on some of the challenges and opportunities they're facing.
Right.
But what about the stock itself? You mentioned earlier that it rarely trades at a discount.
Yes.
What does that mean for someone who's considering buying in now?
Well, Ferrari's stock price often reflects the company's premium brand.
Right.
And strong performance. It tends to stay at a higher valuation compared to other car companies.
So if someone's looking for a bargain stock, this probably isn't it.
Probably not. You might be paying a premium to invest in Ferrari, but you're also potentially buying into a company with a proven track record of success.
So it's not about trying to find a steal. It's about investing in a company that you believe in and that you think has long-term growth potential.
Exactly. It's important to remember that stock prices can fluctuate. Right. We've seen a recent dip in Ferrari's stock performance, which might make it more appealing to some investors.
So is this a good time to buy?
Well, that's a question only you can answer based on your own research and risk tolerance.
Okay.
It's essential to look beyond those short-term fluctuations and consider the long-term prospects of the company.
So don't get caught up in the day-to-day ups and downs of the market.
Right.
Focus on the bigger picture.
Precisely. Do you believe in Ferrari's brand?
Right.
Do you believe in their ability to navigate the challenges ahead and continue to innovate in the luxury automotive space? If the answer is yes, then a dip in the stock price could present a buying opportunity.
All right, so it's not about trying to time the market perfectly. It's about understanding the company, its strengths, its weaknesses, and its potential for long-term growth.
That's right. Investing is a marathon, not a sprint. And with a company like Ferrari, it's important to keep your eyes on the long game.
Okay, we've covered a lot of ground today, from the roar of the F80 engine to the intricacies of Ferrari's financials.
It's been quite a journey.
But there's one more crucial piece of the puzzle we need to address.
Oh.
Those key financial metrics that investors should be watching.
Right.
How can we use those numbers to make informed decisions about whether or not to invest in Ferrari?
Let's do it.
Okay, so we're back and ready to crunch some numbers. I know financial statements can sometimes seem like a foreign language, but stick with us. We'll translate those numbers into plain English, and see what they reveal about Ferrari's financial health.
Numbers can tell a compelling story, and in Ferrari's case, it's a story of consistent profitability and strategic financial management.
All right, so where do we even begin? What are the key financial metrics that we should be paying attention to when we're trying to evaluate a company like Ferrari?
Well, when evaluating any company, it's crucial to look at revenue, profit margins, and earnings per share. These are fundamental metrics that give us a good snapshot of the company's overall financial health and its ability to generate profits.
Okay, so revenue is basically the total amount of money that the company brings in from its sales.
That's right.
What about profit margins? What exactly are those?
Profit margins tell us how much profit a company makes for every dollar of revenue it generates.
Okay.
It's a measure of efficiency and pricing power. And as we discussed earlier, Ferrari has historically maintained exceptionally high profit margins,
Right.
which is a big part of what makes them so attractive to investors.
So a higher profit margin means that they're keeping more of the money they make from each sale,
Exactly.
which is a good thing.
It's a good thing.
And
It shows
yeah.
they're managing their costs effectively and have the ability to command premium prices for their products.
And what about earnings per share?
Right.
You mentioned that earlier, but I'm still not entirely sure what that means.
Earnings per share, or EPS, is basically the portion of a company's profit
Okay.
that is allocated to each outstanding share of stock. It's a closely watched metric because it directly impacts the value of the stock.
Yeah.
Generally, higher earnings per share translate to a higher stock price.
So if a company's earnings per share are increasing, that's usually a positive sign.
Yes, it suggests that the company is becoming more profitable,
Okay.
which can lead to higher dividends for shareholders and a potential increase in the stock's value.
Okay, so we've got revenue, profit margins, and earnings per share.
Mm-hmm.
Are there any other financial indicators we should keep in mind when evaluating Ferrari?
Well, debt levels are also important.
Okay.
High levels of debt can put a strain on a company's finances, especially if interest rates rise.
Right.
However, in Ferrari's case, they have a very healthy balance sheet with very manageable debt levels.
So they're not overly burdened by debt,
No, they're not.
which gives them more financial flexibility.
Exactly. This allows them to invest in new technologies like their electric supercar development without taking on excessive financial risk.
So how do we put all of this financial information together? How could we use it to make informed investment decisions about Ferrari?
Well, it's all about looking for trends and comparing Ferrari's performance to its peers in the luxury car market
Okay.
and to the overall market.
Yeah.
Is their revenue growing steadily? Are their profit margins remaining strong? Are their earnings per share meeting or exceeding analyst expectations?
So we need to see if they're consistently performing well and if they're outperforming their competition.
Exactly. And if the answer to those questions is yes, it's a good indicator that the company is on solid financial footing
Okay.
and well-positioned for future growth. However, it's important to remember that past performance doesn't guarantee future results.
Right.
The automotive industry is constantly evolving, and there are always risks to consider.
Right, like those potential challenges in the Chinese market.
Right.
And the ongoing shift towards electric vehicles that we talked about.
Exactly. So while Ferrari's financials paint a positive picture, it's crucial to stay informed about industry trends and the potential headwinds that they might face in the future.
So we need to approach this with cautious optimism.
I think that's a good way to put it.
Look at the numbers,
Mm-hmm.
understand the trends, but also be aware of the potential risks and challenges that Ferrari might encounter.
That's the essence of sound investing.
Right.
It's about finding a balance between potential rewards and potential risks.
Yeah, okay.
And making well-informed decisions based on your own individual financial goals and risk tolerance.
So for a listener who's been considering adding Ferrari to their investment portfolio, what's the takeaway here?
Well, Ferrari is undoubtedly a unique company. They have a globally recognized brand, a history of robust financial performance,
Yeah.
and a clear vision for the future.
Yeah.
However, they also operate in a fiercely competitive and rapidly changing industry.
So there's a potential for significant rewards,
Absolutely.
but also some inherent risks that come with investing in a company in such a dynamic industry.
Exactly. The decision to invest in Ferrari is a personal one. It's about weighing the potential upside against the potential downside and deciding if it aligns with your individual investment goals and risk tolerance.
Okay.
Do your research understand the company and make an informed decision?
Great advice.
Yeah.
All right, so we've covered a lot of ground today. We explored the allure of the F80, delved into Ferrari's unique business model, and even decoded their financial statements. We didn't just stop at the numbers, we also considered the broader context of the automotive industry, the challenges and the opportunities that lie ahead.
We really tried to give you a holistic view.
We did. I hope it was helpful for our listeners out there.
I hope so too.
Now, before we wrap up, I want to leave you with one final thought to ponder.
Okay.
Ferrari's success has been built on cultivating a sense of exclusivity and aspiration. What other industries could potentially benefit from adopting this type of luxury branding strategy? Could we see other companies, perhaps in unexpected sectors, successfully replicating the Ferrari model? That's something to think about as you continue your exploration of the investment world. Thanks for joining us on the Deep Dive.